Good day, everyone. My name is Niël Hougaard, and thank you for joining us in this discussion on the Glacier Invest Living Annuity Income Solutions. Today, we'll drill a bit deeper into two of the underlying managers that forms part of the respective solutions. It is our aim for you, the audience, to get greater insight into the management of these strategies, and thereby also showcasing why we believe as an investment team that they are a good fit for the broader solutions. Joining me today from Matrix Fund Managers, Lourens Pretorius. Lourens is the manager on the Amplify Defensive Balance and Amplify Absolute Fund. And Iain Power. Iain is from Truffle Asset Management, and he's the manager on Amplify Wealth Protector and also the Truffle Flexible Equity Strategy. Gentlemen, thank you for joining me.
Thanks, Niël.
A question that I want to pose to the both of you, and Lourens, perhaps I'll come to you first. In constructing a portfolio for a retired individual, capital protection, it's obviously paramount, but it's also important to achieve the growth in order to deliver the regular income for the client. So what I want to get from you is just, how do you guys approach the management of your strategy in order to help us achieve this target?
Hello, everybody. Thank you, Niël. Well, I'll start with saying maybe just some salient features, and hopefully it explains how we think about managing the portfolio and how we conduct ourselves. But for us, the primary goal in this mandate is really to achieve inflation +3 or beat inflation +3 consistently and with the greatest certainty almost. So that's paramount in the construction of the portfolio. We like to think about scenarios. We typically have a monthly meeting, but we don't manage by meetings. And in such a meeting, we would construct across different asset classes or different investment opportunities, a typical base case scenario and alternative scenarios, not a worst case or a best case scenario, but more 80th and a 20th percentile type of scenario. And we obviously try and substantiate all three of those as good as we can. And that gives us an ability. I should also say that these scenarios are typically constructed with a rolling 12-month forward-looking view. And that holds some value in itself, in the sense that we're thinking rather short-term in terms of comparing different investment opportunities to each other. And if you were to think about it through that lens, it is quite different to a typical strategic asset allocation framework. For us, strategic asset allocation is an optimized version of what has worked in the past, and it's not to be overly critical on it, but the future is inherently different. And even if one were to think of a strategic asset allocation outcome, it more often than not has some interim volatility associated to it, which talks to this whole problem of sequence risk as well. So what we are trying to do is to select the investment opportunities or overweight in the investment opportunities where number one, it's apparent to us that it's not dilutive to our investment objective. It reaches the investment objective, but also it reaches it with the highest degree of certainty. So we'd always veer towards selecting opportunities where there's lesser negative tails associated to it. So if there were to be superior investment opportunities, but with nasty negative tails or potential negative tails per our assessment, we would probably veer more towards the slightly more inferior return outcomes, as long as they're not dilutive to our investment return, but to the extent that they are carry a higher degree of certainty in achieving the investment objective. So I think it really talks to tactical asset allocation. We are unashamed tactical allocators. Throughout the last 5 years, certainly on our side, I think there's plenty evidence that there's significant value to be had through tactical allocation. I have to again stress that doesn't mean we tactically change our view every 4 weeks. It means that we constantly assess information and asset classes and investment opportunities and have the ability to be nimble and pragmatic and to be able to shift across investment opportunities. Doesn't mean to say that we're traders and we trade every day or every second day, but it talks to nimbleness. And our experience has been that we not only add roughly 1.5% of alpha to a typical static strategic asset allocation portfolio, but also we reduce volatility tremendously. And that talks to an outcome where on a rolling 1 year basis, we have never had negative alpha stemming from tactical asset allocation. We've reduced volatility to about a 3% vol. So I think, in summary, it's really a focus upon achieving with the highest degree of certainty and with the utmost consistency an inflation-beating return in excess of 3%, and to be doing so time and time again. And to almost remove timing risk, if you want to, for the investor. And that's the way we see the mandate, and that's the way we'll continue to manage the mandate. Very much absolute return focused outcome.
Yeah, Niël. So, hi everyone. I think from a Truffle perspective, the way we look at the wealth protector is very much around its mandate and the objectives that it's trying to achieve. So, we also have a CPI plus 3% target, and to the extent that one can find assets that can meet and beat and exceed that performance hurdle, we try and look to build a diversified portfolio from a bottom-up perspective of as many uncorrelated positions and assets as possible, but with one big key difference to many of our peers, where we think we have a big advantage is the management of risk and downside. So I think one of the big things that we've learned in our business and across our intellectual capital accumulation period of all the fund managers and investment professionals in our business is that experience gives you a huge amount of value in terms of gaining insight into tail risks or risks that you don't necessarily see when you're looking at a portfolio or you're looking at sort of companies. And I think the bottom line is we have been able to craft and construct a diversified portfolio of assets, which gives you the ability to meet and beat the CPI plus 3 hurdle, but at the same time making sure that the capital is preserved even in the event of big hits and big shocks in the market. And that doesn't just take place at a broad market level, in other words, at a beta level where we're hedging market risk. It's actually fundamental to your stock picking and security selection in your portfolio. So effectively what we're always trying to do at any given point in time is, whether it's in the fixed income space or whether it's in the equity space, is we're looking to get the benefit of diversity through valuation and margin of safety. So where we can find securities where the return distribution is very skewed to the upside, and at the same time steering clear of a lot of value traps and bombs which have taken out a lot of other managers. And there's many, many examples of that. So I think that's where we've really made the difference, is we are able to craft a robust portfolio of multi-asset classes and select those securities from a bottom-up perspective that will beat the CPI plus 3% target, but with the smallest amount of risk. And at the same time, using our hedging strategies and through our experience and the robustness of our process to then mitigate big market beta and drawdowns. So I think, from a fund management point of view, one of the big benefits that we have is our size and nimbleness. So because we are small, we are able to react very quickly to market conditions and take advantage of volatility to the extent that bigger managers, frankly, are not able to do. And I think that really has come through in our returns. And, certainly the big focus, I think, if you had to think about our offering, is what we are trying to do is we're trying to limit downside. So when the market has drawdowns, we are trying to limit the amount of money that we lose. First prize is to lose nothing. But then when there is beta and stock selection or security selection opportunities, is to participate in the beta plus the alpha that we can put on top of that. So if you think about the return algorithm of the fund, it's to protect capital by focusing on underpriced securities relative to their value, and then making sure through hedging, stock selection, asset diversification, the way we put the portfolio together, that when you have negative market drawdowns or when the market goes down, that we lose as little as possible, and that when the market recovers and you get beta and the alpha opportunities from stock selection, then you can add significant returns. So I think that lever of protecting capital is often overlooked in the long-term compounding in terms of achieving your investment objectives. If you can just lose a bit less when the market goes down or not lose money at all, it makes it much, much easier to achieve your long-term objectives of delivering, real inflation-beating returns over time.
I want you guys to just tell me a bit about your COVID-19 experience or the portfolio's experience. Obviously, it's very topical now. I mean, what was the positioning like going into the crisis? How did you manage to navigate throughout these turbulent times? And perhaps even, how do you see things play out? And Iain, maybe let's go to you again, and then we go to Lourens.
So from a Truffle perspective, we were quite defensive going into COVID. We were certainly quite cautious on global equities. So we were under-indexed insofar as our offshore risk asset exposure. And we also had some put protection on our fund, in other words, some market protection, which we had on the basis of just valuations being expensive, and we thought that there were potential earnings disappointments coming through insofar as the offshore equity market. So that would be the first point. Second point is we were increasing liquidity in the portfolio. We were less focused on chasing yield or trying to get an extra 50 basis points on our credit or on our fixed income. So we were looking for more liquidity, higher quality of assets. And then from an equity perspective, we've been very focused on those higher quality businesses, even prior to COVID, which had strong balance sheets, which did not have excessive leverage, and that we felt could withstand a certain amount of market volatility. So what transpired is obviously nothing that one predicted, but I think it certainly introduced a significant shock to all businesses, most businesses' cash flows, and to the extent that certain businesses which maybe don't have strong competitive moats and that were highly levered or in fact maybe had slightly too much gearing, there was significant price destruction, and in many cases permanent value destruction. So we managed to avoid many of those situations, and I think often managers and fund managers will come and say to you that we've got this diversified portfolio, and during times of crisis bonds actually perform well because they're uncorrelated to equities. But the reality is, if I look back at my 30 years of experience in markets, is when you have these big shocks to the market, correlations across all asset classes go close to 1, and you can potentially suffer losses, and only cash really protects you in that environment. So I think, the ultimate diversifier is value. And the one thing which we strive to do is within our asset classes is to make sure that we are buying 1 rand of assets at a discount where there's a big margin of safety. And typically that protects you over time. So the price you pay for the asset will really be the determinant of your future returns and the extent to which your portfolio can withstand these shocks. But broadly, we were well positioned, relatively well positioned, defensively positioned, and certainly did not lose capital to the extent that many of our competitors did in terms of those drawdowns, and then also have the ability or had the ability to add exposure to quality assets that get sold down with poor quality assets. And maybe that's something I can spend maybe 30 seconds taking you through. When you have shocks and crises in financial markets, as I said earlier, correlations all go to 1. So typically a good company gets sold down with the bad company, and you then get the opportunity to buy into good companies with good business models at attractive or at worst at fair prices. And this gives you an opportunity in a crisis to raise the quality in your portfolio if it is a sensible thing to do, and it doesn't sacrifice value. So at all points in time, we are looking to ensure that we can deliver the inflation-beating returns, but minimize that risk. So if there are two shares, for example, in the portfolio that have more or less the same return in terms of upside, but the one has tail risks insofar as its capital structure that's starting to come into play because of, let's say, a COVID shock, and you can switch the lower quality share into, let's say, a higher quality share without sacrificing value, you just increase the risk-adjusted base or the risk-adjusted return potential of your portfolio over time. So I think, in summary, I would say that shocks by definition are something that you cannot predict. But I think to the extent that our focus on downside risk and capital protection really came to the front to the extent that we delivered on that first promise. And then secondly, when you have the drawdown on asset prices, then giving us the ability to put capital back into the market to participate in potential beta recovery, as well as the stock selection alpha opportunities that were on offer during the crisis.
Lourens, I know that, you touched on it earlier, but maybe initially your experience was a bit different going into the crisis, but it also turned out, reasonably well. If you look at the last couple of weeks, how the performance picked up, and maybe if you just want to elaborate a bit as well.
There's no doubt when you hit these unexpected occurrences globally and locally, and we've had a few locally as well, more often than not, there's no way to hide, despite diversification, to prevent capital loss. It was a little bit of a new experience to us to see the extent of capital loss. I think our biggest drawdown prior to this was 3 or 3.5%, not even capital loss, but just drawdown, and this touched on almost double that. One of the main reasons has been that we went into the crisis somewhat overweight in the bond market, and what can go wrong. We certainly held the view that there's some fiscal reforms or evidence of fiscal reforms, and that a steep yield curve renders very decent real yield opportunities and potentially even some duration compression opportunities. And obviously bonds sold off 400 basis points during this crisis, largely on concerns, I would say almost a perfect storm of a downgrade and an expulsion or exclusion out of the World Government Bond Index, and that coupled with an enormously ballooning fiscal burden almost, plus a demise in liquidity. And that certainly had been a bit of an unexpected move. So we went in a little bit overweight on bonds. We lost about 3% of value as a consequence of only the bond side of things. We lost a further 3 and a bit % on equities, which we were quite underweight on. The bonds have subsequently recovered and added a 5% positive return, not only on what we held, but also what we managed to increase our holdings at very favorable levels. The big question is where to from here, and I tend to feel, if I can maybe talk a little bit about that. When we do our scenario analysis and we look at our probability weighted returns and we look at likely outcomes across asset classes, quite frankly, nothing excites us tremendously at the moment at an asset class level. There's certainly some more granular opportunities within equities, and one could look for opportunities on yield curve plays in bonds. But the true reality is our base case scenarios across equities is roughly 10% thereabouts. On bonds, we rather skeptical at these levels and have taken a very overweight position and trimmed it to very underweight at the moment. Maybe talks a bit to that tactical bent as well. But we see a very onerous supply burden hitting the market. And, we think tactically we'd like to be heavier, but we'd like to benefit from very apparent value at even more apparent value on the bond side. So the consequence is that cash or fixed cash. I should say we think that there's further interest rate accommodation quite likely due. We think inflation will allow it and growth will require it. So to that extent, we have a large portion of cash, but we fix our cash typically for a year or two, pick up 100 basis points. But cash at 6%, or cash proxy then, is not that bad relative to an inflation outlook of 3%. And if you don't have enormous conviction on anything at the moment. So we'd like to think that there will be better opportunities to increase equity exposure, whether that's local or offshore. We'd like to think that economies and earnings by implication will be under pressure, and it's probably a bit underestimated at the moment, and there's too much of a value chase at the moment, which is not value anymore. And similarly on the fixed income side, we think there will be better opportunities to be had, and I think that talks again to what Iain alluded to as well: tactical ability, nimble ability. There's nothing wrong to be sitting on your hands a little bit, and don't ever let cash burn a hole in your pocket. If you don't see a reason to spend it, and it can be a placeholder for some time, then it's certainly something that we embrace as well. And I'll conclude in saying it is an active decision to be overweight in cash or to be significantly overweight in cash. And as long as that's not your permanent position, I think it should be recognized as also a decision.
Another question I wanted to pose you in a low cash yield environment. I mean, we've got the developed market, pretty much throughout sitting with negative real rates. I mean, I actually wanted to, do you think, South Africa is perhaps heading towards the same path? I mean, we've got some emerging market countries where policy rates are also getting close to zero. Or do you think, that won't happen?
We're very, I'm not sure if I should say positive or negative, but we have a very disinflationary view. We believe that 12-month inflation could well average even below 3% for a whole host of reasons. So a 6% outcome or a 7% outcome in a very low volatility investment, as much as it's low in terms of nominal outcomes, is not necessarily the worst investment to be achieving with a view on where inflation outcomes are likely going to be. I should also say that I'm really not of the opinion that South Africa can afford to run persistent negative or even zero real interest rates. In my mind, it's a very temporary phenomena. It's not sustainable. We will see currency depreciation, and the primary mandate of a very orthodox central bank and very credible central bank is to protect the purchasing power of the currency. So in my mind, 1.5% to 2% positive real rate in pure cash is probably the long-term cash risk premium, if you want to, in South Africa. So cash is a real alternative from time to time. And to the question of, are there other opportunities? Definitely. If I were to just simplistically think outside of equities, let's think about a low equity balance fund. If cash is going to yield you 5% and you see inflation at 3%, that's already a real yield of 2%. If bonds yield you 6 to 7% real yield, dependent on where on the yield curve you are, and if inflation linkers, not a 10 or 20 year, but 7-year inflation linkers provide you with an almost 4% real yield, then if you simplistically were to have 20% of each of those, then 2/3 of your portfolio is already delivering you inflation plus, or in excess of inflation plus 3. So then basically you need to do your job on the equity side with your remaining 30 to 40%, or call it 25 to 40%. And one hope that equities comes back and provides relevant return, but also construct your portfolio in the relevant counters where you see significant enough upside. So I don't think it's particularly challenging. I just think it's a mindset to recognize that it's beating a low inflation benchmark at the moment. And if you consistently focused on beating that benchmark and structure your portfolio to that, inevitably in higher inflation periods, there will be other asset classes that will enable you to deliver relative to that inflation objective.
Thank you. I mean, Iain, before we wrap up, maybe, I mean, I mentioned at the start that you managed to amplify Wealth Protector, but also, I mean, as we go up the risk spectrum in the other solutions, you also manage the Truffle flexible equity. So it's two completely different risk profiles or completely different risk budgets. When you look at stock picking, is there different factors that you look at?
So I think from a security selection perspective, I mean, obviously when you've got a very discrete capital guarantee or where we are aiming not to lose any capital, one always wants to make sure that you are only taking risks that you want to take. And I think that's something that's very important in investments, is that to identify when you're buying a security, what are those risks, and that the risk return probabilities are actually in your favor. So in other words, the security is trading very cheaply given the risks as you understand them versus its value, and we are happy to allocate capital to that security. So this thing you don't want is you don't want other risks or non-quantifiable risks, or risks to the extent that maybe they are that you wouldn't necessarily entertain if you were putting capital into those ideas. So what we try and do with the security selection process that we run across all our funds is we are not only trying to optimize return across every single portfolio or from a security selection perspective, but we are trying to minimize risks. But more importantly, it's the risks that potentially could surprise you. And those risks can take many different forms. And for example, a company with in a normal economic cycle with net debt to EBITDA of 2.5 times, maybe the business has got operational leverage. In other words, it's fixed costs relative to total costs are quite high, and if you have an interruption to the flow of business through that, like for example a hotel, when once tonight is gone, that opportunity to have bums in beds is gone, and you lose that money. And I think if you have a shock to the system where optically under normalized scenario the capital structure looked appropriate, but under a scenario where maybe you're going into a more difficult economic cycle, or things or probability of economic activity slowing or shocks, you need to start thinking about those risks. And that's what we try and do. So we're not only trying to focus on the return component of the portfolio, and we very much focus on, at a security selection level, the inherent risks as we are prepared to take on in putting capital in, but then also looking at securities to the extent to say that if the environment changes to the extent you can have a shock, this business which looks sustainable today might suddenly become very unsustainable very quickly overnight. And I think it's to try and build that portfolio out in a way where, as we are in a very uncertain world now, and with COVID, I'm guessing we are going to have second round waves of infections. We don't know how governments will react this time. But the bottom line is no one knows the path to recovery. Is it a smooth path? Is it a fast path? Is it volatile? That's the one thing we think it will be, is volatile. And then you need to structure the portfolio accordingly. And not just at an overall strategic asset allocation level. In other words, the amount of risk that we're taking on in the portfolio, but it's at a security level. And to look at those securities and say, if there is an interruption to economic growth and the underlying cash flows that this business makes, can it sustain itself? Is the business model sustainable in this environment? And I think it's those questions that and an interrogation at a portfolio level that adds a huge amount of value once those risks manifest. So it's like insurance. Insurance is a grudge purchase, but boy, after you've had your car crash, you realize the value of your insurance. And I think it's really just to try and get a sense of the bigger picture that we're in terms of the world and the path that we are traveling down, and then to structure the portfolio in a way to say that the probability of those fat tails to the left-hand side of the bell curve, there's probably a higher probability of them coming into play.
Okay. Guys, unfortunately, our time has run out. But I want to thank you for taking out the time. It's been really insightful. And if I can just summarize, I think it's clear that even though the management style of these two strategies are not completely similar, you guys have both been very, very successful in achieving what we want you to achieve. And therefore, I commend you. And so I thank you for taking out the time and all the best.